In January 2026, the United States Department of Justice served the Federal Reserve with grand jury subpoenas. Not for financial fraud. Not for insider trading. But for the cost of renovating a building on the National Mall. Jerome Powell, chairman of the most powerful central bank on earth, said it plainly in a rare public statement. This was not about a building. It was a political attack on the independence of the Federal Reserve. And if it succeeds, the consequences for every American will be felt for decades. The Federal Reserve was created in 1913 to prevent financial panics. Since then, it has become the most powerful financial institution in human history. When the Fed raises interest rates, mortgages get more expensive, businesses stop hiring, and economies slow. When it cuts rates, credit flows, spending rises, and economies heat up. It controls the price of the dollar, which is the world's reserve currency, meaning its decisions ripple through every economy on Earth. And deliberately, by law, it operates independently from the president. That is not an accident. It is the entire point. This is not the first time a U.S. president has tried to bend the Federal Reserve to his will. In 1970, Richard Nixon appointed Arthur Burns as Fed chairman. Nixon wanted easy money to fuel economic growth ahead of his 1972 re-election. Burns caved. The Fed kept interest rates artificially low. Money flooded the economy. In the short term, Nixon won his landslide. In the long term, the United States suffered a decade of stagflation, inflation above 10% for years. It took Paul Volcker slamming rates to 20% in 1981 to break it. The economic pain of that reset was severe. Unemployment hit 10.8%. The lesson was written in blood: when politics controls monetary policy, everyone pays. Donald Trump's war on Jerome Powell began with tweets and ended with federal subpoenas. Trump had wanted rate cuts since returning to office, cuts that would fuel growth and lower borrowing costs for his administration's economic agenda. Powell refused. The Fed was navigating stubborn inflation and held rates steady. Trump publicly called Powell a fool. He said he would love to fire him. Then, in January 2026, the Department of Justice opened a criminal investigation, ostensibly over the cost of renovating the Fed's historic headquarters on the National Mall, which had swelled to $2.5 billion. Powell said in an unusually combative public statement that prosecutors were using the renovation as a pretext to interfere with the Federal Reserve's independence. He called it an attempt to intimidate the institution into cutting rates. On January 30, 2026, Trump nominated Kevin Warsh, a former Federal Reserve governor and Wall Street figure who had spent months signaling that he supported lower interest rates. Warsh's confirmation hearing became a spectacle. Democrats hammered him on whether he would act as Trump's puppet. Warsh vowed he would not be, in his words, a sock puppet for the president. On April 21, the Senate confirmed him 54-45, the most partisan Fed chair confirmation ever recorded. The message from markets was immediate unease. The dollar dipped. Bond yields moved. Traders wondered, is the Fed still independent, or has it just changed hands? Here is the uncomfortable irony at the center of this story. Trump wanted rate cuts. He wanted a compliant Fed chair. He got Warsh. But Warsh arrived to find an economy that made rate cuts impossible. The Iran war drove a global energy shock. Oil prices surged. Inflation, which had fallen to near 2% in 2025, reversed sharply. The PCE inflation measure, the Fed's preferred gauge, was revised from 2.7% all the way up to 3.6% for 2026. The Fed held rates steady at 3.5 to 3.75% for 4 consecutive meetings. And then came the twist. By July, markets were pricing in a possible rate hike. Trump did not get his rate cuts. He got a Fed chair who now says inflation is too high, and sounds remarkably like the man he replaced. Why does Fed independence matter so much? The data is unambiguous. Countries with genuinely independent central banks have maintained, on average, 4.5 times lower inflation over the past 50 years compared to countries where politicians control monetary policy. The mechanism is straightforward. Politicians want growth before elections. Growth often means cutting rates and printing money. Inflation follows. An independent central bank's entire job is to say no to that. Its only constituency is price stability, not the next election cycle. When that independence erodes, inflation expectations become unanchored. Businesses and workers start pricing in higher future inflation when they set wages and prices, and that expectation becomes self-fulfilling. There is a second consequence that almost nobody is talking about. The US dollar's status as the world's reserve currency rests on one thing above all else: trust. The belief that American monetary policy will always prioritize stability over short-term political gain. The dollar's share of global reserves has already fallen from 73% in 2001 to 54% in 2026. BRICS nations are accelerating alternatives: mBridge, BRICS Pay, digital yuan settlement networks. None of these are ready to replace the dollar today. But every crack in the Fed's credibility narrows the gap. If global investors conclude that the United States has politicized its central bank, the retreat from dollar-denominated assets accelerates. And the consequences of that: higher borrowing costs for the U.S. government, a weaker dollar, import inflation, are severe and long-lasting. Kevin Warsh has surprised almost everyone. At the ECB forum in Sintra, Portugal on July 1, 2026, the man who won his Fed chairmanship partly by signaling support for lower rates told the world that inflation was too high and that the Fed would remain independent of political pressure. He walked back every pre-confirmation signal. Markets now expect a rate hike, not a cut, by September. The question is whether this represents genuine independence or strategic positioning. Warsh knows that if he delivers rate cuts now, he validates every criticism that he was installed as a political instrument. The bond market, the dollar, and America's global financial credibility all ride on whether the next 12 months prove him right. Here is where we stand. Trump mounted the most aggressive attack on Federal Reserve independence in American history: criminal investigations, the most partisan confirmation ever, public pressure campaigns. Powell held firm, paid a political price, and ended his term with his reputation intact. Warsh arrived promising independence, and has so far delivered it, driven as much by inflation data as by institutional conviction. But the institutional damage is real. The norms that protected the Fed for a century, that the president does not direct monetary policy, have been tested in ways that will tempt future administrations. The Nixon-Burns episode took a decade of pain and a 20% interest rate to fix. If this experiment ends badly, if the next Fed chair bends, the lesson of history is that the cost of recovery will be paid not by the politicians who broke it, but by every American who carries a mortgage, loses a job, or watches their savings eroded by inflation they cannot outrun.